Hello, everyone. Today on the final bar, we'll hit the market from three directions: top-down macro, bottom-up stock picking, sector rotation. Monday's show is a fun one because we hit on all the key charts in each of those three major areas. The S&P up for the most part today, although it distributed pretty good here in the last hour, but overall energy materials leading the way higher. We'll talk about some of the stocks reporting earnings this week, some of the names and charts you should be aware of. Ladies and gentlemen, this is the final bar. Hello, everyone, and welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the markets together using the power of stock charts, using data visualization as a way of understanding market dynamics, fear, greed, desperation, excitement, euphoria, panic. All of that, I would argue, is reflected in the price of assets. And by focusing on the charts and how those charts are evolving, where the trends are in play, what's working, what isn't, you can have a good understanding of the overall market movements and make sure that you're positioned in the most effective way possible, or managing your risk and your reward opportunities. A big week again for earnings. We've got a lot of different companies reporting. So when we get to our shifting stock segment a little later, we're going to focus on some of the stocks that are reporting this week. Also focus on some of the main groups like the FANG stocks, the MVP stocks, MasterCard, Visa, PayPal, and others. Now, we have great guests on the show. Last week, as always, really good group of guest speakers. This week, tomorrow on Tuesday the 4th, we have one of my mentors, Jeff Weiss from Clearview Trading Advisors. Jeff is a longtime technical analyst, worked for years and years with some of the top technical analysts on the street. He has always reminded me to keep it simple, to focus on the long term, to be patient. And so really interesting to get his take on the market tomorrow. On Wednesday, the 5th, Sean McLaughlin from All Star Charts. Sean is an options expert. He sat on our Options 101 panel a couple of weeks ago and was really, really well done in terms of guidance for people just getting started with equity derivatives. On Thursday, May 6th, Xenia Taubina from XT Financial Services. Xenia is more of a short-term trader focusing on Elliott Wave. Very different toolkit, different time frame from myself, and I always find it really helpful to talk to someone who's looking at things completely differently, see how our inputs and our toolkits, what they say relative to one another. Also, just as a reminder, coming up tomorrow on May 4th, there's a couple spots left in my own webcast called Sell in May, 5 Charts You Need to Review. We're going to talk about the seasonal tendencies in the market now that we're in the weakest 6 months, the weaker 6 months, May through October. We'll talk about what that means, in particular, 5 charts you want to keep in mind to understand how those seasonal trends may be evolving this year. If you're interested, go to marketmisbehavior.com/sell in May. You can sign up for free there. And I hope to have you join me tomorrow on May 4th. Let's continue on with our market recap as we're looking at the S&P today. It's sort of mixed messages, although overall net positive. The S&P closing just below 4,200. It's been a couple times today dipping above that 4,200 level, but the last hour was some weakness. So selling through, sort of the 3 o'clock hour Eastern time. So the S&P finishing still up 0.25%. The NASDAQ composite, by the way, finishing at the lows of the day, down 0.5%. This is one of those days where you have technology and communication services in the red, energy and materials, healthcare, industrials in the green, and that's going to make the S&P and especially the Dow outperform the NASDAQ, and that's what we've seen. How many times in the last month or two have we seen that? With the Dow up, the NASDAQ down, or the reverse, the NASDAQ up, the Dow down in absolute terms, and the S&P is sort of in the middle, sort of chopping around. When you look at the chart of the S&P 500, overall, the long-term trend is positive. That's undeniable. But if you look in the short term, you're seeing a lot of short-term indecision candles, doji candles, and the like. We're going to look at that here in a moment. Mid caps and small caps, however, sort of in a thumbs up risk on mode. They all sort of sold off there in the last hour, but small caps, the best of the bunch, up about 1.2%. And the VIX is back down nearing the 18 level. Bond prices sort of flat 10-year yield coming down about 1.5%, around 161 or so. The dollar was down about 0.5%. Commodities essentially up across the board for the most part. Gold and silver, the precious metals, which a lot have been watching as sort of a defensive play, gapping higher and sort of spending most of the day up. Oil prices up, and that's why energy is the number one sector out of the bunch. Some big movements in cryptocurrencies. A lot of discussion I saw end of last week and over the weekend was looking at Ethereum relative to Bitcoin, and in some ways covertly or overtly describing the emergence of Ethereum and how that is sort of the Bitcoin sort of done and Ethereum sort of the next thing. People talking about the Ethereum to Bitcoin ratio and looking at how it's breaking out to the upside, and certainly seeing some follow through today with Ethereum up about 11%. Bitcoin, however, just fine around 57,300, still off of all-time highs, of course. Let's look at a chart of the S&P 500. Let's start there, and we'll continue our discussion about the macro environment. Then second, as I mentioned, we'll get to sectors. We'll come back after the break and talk about some individual stocks I think you want to be familiar with. So, when I'm looking at a chart of the S&P 500, I would say three things that come to mind. Number one, what jumps out are the blue dashed lines that I've highlighted here on the right. We have another bearish divergence. We have this situation where the price is going higher and the momentum is going lower. The S&P was overbought in mid-April when it made new all-time highs and broke above 4,100 for the first time. We pulled back a little bit, tested support or created support, I guess, around 4,120, then made a new high. This is until last week, this last Thursday's bar, making a new all-time closing high, and that is with lower momentum. So I've always talked about how, something becoming overbought on its own is not a bad thing. Overbought means up a lot. That's actually good. If you're expecting a chart to go higher, something being overbought is actually a good thing. That tells you overall there is underlying strength behind the price movements. Where I would be concerned once that happens is when the price goes higher and it doesn't become overbought, because that tells you that the upside momentum, the buying power, is sort of dissipating. Think of it as, no one's left to push the price higher. The price is drifting higher, but there's not as much interest in pushing the price materially higher from here. And that, more often than not, tends to coincide with some topping patterns. Now, what's interesting is I don't have it indicated on this chart, but if you look, the last time you had that, where you had a move to all-time highs and it was overbought, a secondary move higher a couple weeks later and it was not overbought, was back here in January. That was actually what we saw the first of the year. First week in January, made a new all-time high above 3,800, pulled back a little bit and made a new high again in late January, and did not become overbought. The market pulled back around 5%, just under that. It wasn't that bad. Pulled back to the 50-day moving average, rotated back and made a new all-time high. Again, pulled back a little bit later, actually broke down through the 50-day moving average for 2 days, but didn't make that previous low, didn't break that previous low. So when I'm looking at the chart of the S&P 500, the first thing that comes to mind is, the first thing I'm noticing is this bearish divergence. That puts it on warning, puts a little warning flag up for me. But what you want to look for then is at some point the S&P needs to correct. I mean, that is arguably overdue, and not just a 1% correction, but something like a 5 to 10% correction. The first line in the sand, and that's the second thing that comes to mind, a very clear support level around 4120. That's the low from the third week in April. And I think as long as that holds, this uptrend, this tactical uptrend remains in play. If you break down through 4120, I think you immediately have to look down to 4,000, which is the 50-day moving average, and this final trend line taking the lows from October and the low from March. I've drawn a couple of those trend lines before. They've each been broken one at a time. Now, all of a sudden, we're at that last and final one. I think if we break 4,000, you have to really start thinking about 3,700, even 3,200, and start thinking about much deeper pullbacks and what they mean. The final thing that I would note on the chart of the S&P 500, then we have to wrap the discussion, is when we did get those 5% pullbacks in January and then again in early March, note that the RSI never got below 40. So if and when we do break 4120, my eyes will immediately go down to this panel, and I'll be looking to see if we hold RSI 40 on any pullback. As long as we do, that uptrend is still in decent shape, and this is still a tactical pullback within a longer term uptrend. That fails, and you start to fail at S&P 4000, you start to fail at RSI 40. I think you have to be concerned about, again, a much greater risk for much deeper price movements and how you'd want to be positioned during that sort of environment. So overall, again, we're coming off of all-time highs, 2 trading days ago. So don't get me wrong, I don't mean to be too negative on it. But again, I'm always looking when things are great. I'm looking for signs when things are potentially not going to be great. And seeing that rotation or that bearish divergence is often the first warning sign. And I'll be looking for some of the additional warning signs as well. As we go on through the course of today's show, talking about sector rotation, talking about individual stocks, we'll probably see some of those themes pop up as well on key levels that stocks would need to hold in a pullback, and what you would see that would tell you that things are getting a little worse than you may be thinking originally. Our next segment is called Sector Setup. So we've talked about the big picture, really only talked about the equity markets this time, really focused on the long-term trend in the S&P, potential trend exhaustion on the upside. Part two here is talking about sector rotation and looking at the 11 S&P sectors. Now, today, for example, you had this sort of move back to the cyclical sectors for the most part, leading the way higher. Energy, number one, up about 2.8%. Materials, number two, and we highlighted in previous weeks some of the charts like FCX and others, which have been pretty decent charts. Also, some of the specialty chemicals names that have done pretty well. And overall, as a sector, doing very nicely. Healthcare, number three, then industrials. So it's really more of a offense sort of cyclical leadership for the most part. On the downside, you have real estate, which is actually relatively a defensive play, higher yielding sort of stocks, although REITs in general cover a lot of different bases. And there are things like retail REITs, which are really more of a play on consumer spending, but overall, it's a higher yielding defensive sector. You also have communication services, consumer discretionary, technology. So three of those sectors, which we think of as offense: tech, consumer discretionary, communication stocks, those three are near the bottom of the list. So overall, not an encouraging sector rotation today. Let's take a look at the longer rotation here. I'm going to refresh the daily RRG. That's where we're going to look today, because I think it illustrates this sort of leadership rotation that we're seeing right now. Those last three sectors that I just mentioned are communication services, technology, and consumer discretionary. Let's say that again, because I think I confused myself. Communication services here, technology here, the XLK, which is now in the lagging quadrant, by the way, and consumer discretionary, which is up here. So these are three of sort of the most offensive and not offensive, but most offense-oriented sectors rotating down in the weakening and or lagging quadrant, all heading southwest, which is not the direction of strength. That's the direction of deterioration, is what I call it. What is actually going northeast, the direction of improvement? Interestingly, you have the XLE, the energy sector, which has actually made a loop here in the right side. So when something makes sort of a 360-degree loop further to the right of the y-axis, that's actually often a really compelling pattern, because what that means is it's outperforming this whole time by the fact that it's further to the right of the y-axis. That means it's just strong. The rotation here is just basically momentum coming in and out of that relative trade, but overall it's still working on a relative basis. And energy has made this round trip of going, northeast, then heading down in the weakening quadrant, and now looping back up into the leading quadrant. So overall, really impressive constructive pattern there. Materials, by the way, also doing just fine, heading this way. The three strongest in terms of their overall push are industrials, financials, and real estate. Again, real estate not doing super well today, but overall, recent weeks have been pretty good. And the relative strength on the XLRE has certainly been turning higher. So, what you need to think about as hold on a second. I'm refreshing this to make sure we get the current data on here. There we go. Yeah, for some reason it's jumping back to late April. I mean, sorry about that. I was going to say, as I'm doing this, I'm thinking, but that doesn't make a ton of sense that they'd be there. No, this makes a little more sense to me. Here's real estate here in the upper right. Now this is making sense. I was just amazed as I was talking about some of those patterns, thinking how that would be, and how communication services would still be over there. Now we are looking at the most recent data. Let's try this again. Energy sector heading northeast, which makes sense, has been pulling back on a relative basis, but rotating just fine to the upside. The XLK, the XLY, just as we were mentioning earlier, sort of rotating in the weakening quadrant, which is indicating some short-term underperformance, right? And overall, not horrible, but it's really heading in the direction of deterioration. Utilities had come out a little bit, and that's why I thought it was right over here, actually getting back into the lagging quadrant on the short term on the daily RRG. So overall, a little weaker than normal. Just to review, what is the strongest now is real estate, the XLRE, and again, when I've talked about real estate, I tend to make an issue of it, not because it's the best chart I've ever seen, but just because people tend to mentally write off REITs because they're not part of your normal process. You're probably not in the normal course of your day, reading up on a lot of REITs, although you might. But I found people tend to, under allocate to that as an asset class, and particularly that as a sector. And at this point, when it's outperforming, a lot of times there's a great opportunity to get into a sector you may not have normally because the trends are worthwhile. Energy, as you know, right? Some of the stocks like, and actually many of them are reporting earnings this week. Things like ConocoPhillips, FANG, Diamondback Energy is actually reporting after the close today on Monday. You have others as well. So certainly the chance for some earnings releases to potentially provide enough of a catalyst to push those sectors to the upper right. Let's finish our discussion on sectors, looking very quickly here at the candle glance page and focusing on the 11 S&P sectors and where they're at. What I'm struck by when I look across this pile of charts is every one of them, given the strength that we've seen, the rebound in energy, all 11 of the S&P sectors are above two upward sloping moving averages. And energy was sort of the outlier, having not done that, but it's back above it to the upside. And I think that rebound of the XLE back above its 50-day moving average is an interesting one. I'll be very interested to see if you continue to see a move higher. That's obviously a play on oil prices, and you're assuming the strength in that part of in commodities, which is really a driver of that. But overall, starting to rotate back up actually after it was making a new swing low below its 50-day moving average. I'm also struck by the consistent uptrends in sectors like industrials, materials, and financials. And again, it can be a little bit misleading. It's always important to look at the relative strength line, because that's really showing you not just what the price is doing, but what the price is doing relative to other sectors. I'm struck by the long-term outperformance on industrials. Looking here at materials, you can see the same thing. Materials, if you look at the trend from the March market low to where we're at now, fits and starts, some jumps around, but overall, look at where we're at on a relative basis relative to where we started. And so some of these sectors have just been consistent gainers in price and consistent outperformers in relative strength. As I look once again at some of the charts that are most attractive over the week, and I'm struck by a lot of the financials, a lot of the banks and others. On Friday, when I was looking at charts for my own research report, I was struck by, again, a lot of the names that have reported in recent week with decent chart patterns, decent setups. I'd be very interested. That is, of course, a play on higher interest rates, which I think are reasonable, are expectable. And so that relative strength is really driven on interest rates bouncing from here. We need to take a quick break. We'll be back with my next segment, Shifting Stocks. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. It's so good to have you join us every weekday after the close as we focus on the markets, focus on the trends and how they evolve, focus on the charts. I always remind people, if you're, the benefit of looking at charts is it represents what investors are thinking, and not just what they're thinking, but what they're actually doing, what they're voting with their capital. There's a lot of speculation on what people think, what people feel, what people might do, what they could do, what they should do. Price tells you what they're actually doing with their investable assets. And it tells you just by looking at the chart, you can understand, are people excited or nervous or panicked or euphoric or desperate? All of that is reflected in the stock price. As a reminder, we're going to do another mailbag segment on Tuesday's show of this week. So get your questions in, anything that's coming up as you're analyzing your own charts and your own login. We're happy to help you with technical indicators, with market history, with market dynamics, investor psychology, whatever it is. Shoot us an email, thefinalbar@stockcharts.com. We are on Twitter @finalbarsctv. Finally, on our YouTube channel, just put a comment below the video that you're watching. We'd love to answer one of your questions on the air. Also, as a reminder, go to StockChartsTV.com. Our on-demand app is free. It is available on the web, also on all the app stores. Just search for StockCharts TV on demand. Use your email account or use your email to set up a free account. You can start watching all of our great content immediately. Our next segment is called Shifting Stocks. We're going to focus now on some individual names, talk about the big picture, talk about the overall, uptrend in stocks, but the exhaustion signals and or divergences that we're seeing that could indicate a potential, end of this uptrend. But what we would need to see to recognize a rollover, we're looking at individual sectors and finding that there are plenty of sectors still working. There are plenty of sectors that are working on an absolute basis and on a relative basis, and things that are actually starting to improve a little bit. Now, how does that happen where the S&P could be have questionable upside, but particular pockets of the market can have decent trends with no real hiccups in play potentially? And that all goes to the fact that the market is not just one thing. It's a market of stocks. I was told early in my career, it's not a stock market. It's a market of stocks. Don't think of the market as one thing. Don't think of it as the S&P and that's it. And I think a lot of investors think of passive products like the S&P, like the NASDAQ, and that's kind of it. Remember that the market, the S&P, is made up of 500 individual stocks. And while there is certainly some relationship between them and certainly some common threads between those different patterns, there's a lot of dispersion, a lot of differentiation. And in an environment like this, I think you're going to find that there are pockets of outperformance and pockets of underperformance. It's a really good time to be focusing on some of those movements. We're going to jump around a bit and look at some of the charts that are that came up in my own process. So my weekly process starts on Thursdays. As I sort of begin the weekly process, I write a research report for my own clients on Friday morning, get ready for this show on Friday afternoon. And then over the weekend, I try to do minimal work, to be totally honest with you, but I usually prepare between Friday into Monday morning somewhere, looking at the S&P 500 charts. I've usually been doing it actually early Monday morning these days, but take time to look at a bunch of charts and focus on some of the trends and patterns that emerge. And, a chart that stood out to me this weekend was Peloton. And we've talked about the chart, but, when I think about the types of charts and the types of stocks that I think a lot of people have gotten very excited about, I'm seeing this chart and I'm seeing what seems like a really clear head and shoulders top forming. And again, you can't really call it a head and shoulders top until you break the neckline, which is the swing low between the head, that high, and two lower highs. And you've had a clear top in January, really was in December, and then retested that in January of 2021. You had a left shoulder, a previous peak in October. You have a similar height right shoulder, a previous peak, which tested the 50-day moving average before rolling over. That was in early April. And now you're testing this neckline. We break below around 92, 93, the lows from these two bars. This measures a lot lower, and sort of my eyeball count puts it down around 50, 55, 60, somewhere in that range, but a lot lower than here. I mean, that's a 40 to 50% drop from current levels. That certainly measures a lot lower, and it indicates some real weakness in the chart. What also strikes me about the chart of Peloton is that the RSI peaked out around 60, which again is more of a bear market sort of phase where you become oversold on sell-offs when you rally up. Compare that to what you saw in the third and fourth quarter of 2021. The rallies, you saw the RSI becomes overbought. When you pull back, the RSI never really gets below 40. That all changed in February to March when you sold off and you became oversold. Now the next rally, the RSI doesn't get above 60, and now you're rolling over once again. So really close on a chart like Peloton to signaling some real pain going forward. I think that's a bit of a potential issue for sure, and not just for Peloton, but I think what that means for sort of the risk on trade, particularly in this type of market. These are sort of the work from home, stay at home stocks. That's sort of this whole emerging trade. And I think the other chart where you'd find this reflected is on the ARK Innovation Fund, ARKK. Again, credit to Arthur Hill, one of our StockCharts contributors, who did a fantastic job highlighting on each of the ARK funds. You have this potential pattern, which is actually a continuation pattern. It's called a coil pattern. We call it a couple different things, but I consider this a coil pattern, which is you have a sell-off, and you could have a rally, by the way, beforehand, but this one in particular, you had a sell-off. You had a bearish divergence, December, January, February, higher highs, lower peaks in momentum. You then sell off and the stock hits a swing low in March, undercutting previous lows. That's not good. After breaking down through the 50-day moving average, that's also not good. Becoming oversold, which is more characteristic of bear markets. That's not good. Then you settle into this consolidation phase. lower highs, higher lows. That's called a coil or a symmetrical triangle because you're kind of coming into the middle. You're rotating around a range. You've hit an equilibrium price. You're kind of bouncing around there. We've now hit the 50-day moving average. We're rolling down to the lower end. The lower end of this pattern is also right at the 200-day moving average, which means if this gets below around 110 on the ARK Innovation Fund, that indicates a much lower move. And that would actually, in general, you kind of measure the height of this and you subtract that from the low. So, and again, I'm totally eyeballing it just for speed, but that's around 85 or so, which would be, again, a decent move below where we're at right now. The relative strength, by the way, is threatening a new 6-month relative low, which is not good. So, overall, you have this rotation lower from names that felt like they were going to go to the moon, now have transitioned into more sideways consolidative patterns. Now all of a sudden starting to threaten the lower end of that range. And I think some of these charts, Peloton, the ARK Innovation Fund, a lot of stocks that you'd see as holdings of the fund are in that similar kind of pattern. I think that has a potential to indicate a much further distribution. Also, just want to point out, and then we have to wrap up. Boy, this show went quickly today. Looking at the FANG stocks, again, the relative strength of the FANG stocks are sort of a similar chart to what I just showed you, looking at the ARK Innovation Fund, sort of rolling over and testing more of the swing lows. Facebook actually has broken out last week to a new gap high. That's actually pretty impressive. Microsoft pulling back, but again, off of all-time highs. What is interesting about some of these, like Amazon, it really never made a new all-time high. So now you have two different buckets within the FANG stocks. You have the Amazons that really haven't broken out yet. Netflix, which really hasn't broken out yet, still range bound for the last 6+ months. But then you have the Alphabets, Microsoft, Facebooks, which have made new highs in the last week or a couple weeks, and overall in a position of strength. So it's almost like the FANGs should be separated into two different buckets: the things that are continuing to work and the things that have not been able to work. And I wonder if grouping them as the FANG stocks, or what I'm calling the FanMag stocks, really makes sense here if you have six buckets of different patterns. Something I'll be thinking about a little more. We need to continue on. Again, a lot more companies reporting this week. I did want to point out the PayPal, which is a company reporting Wednesday after the close. When you're thinking about this week, this is the chart of PayPal. And when you compare MasterCard and Visa, both with relatively strong patterns, making new all-time highs last week, compare that to PayPal, which has not eclipsed its February high. It's sort of the underperformer out of those three. The iPay ETF, which is weighted in things like PayPal, really not confirming the new highs in MasterCard and Visa. So it's sort of the old credit card companies that are pushing higher, which obviously very involved in payment processing these days, but certainly a group of stocks to pay attention to. We need to wrap the show, go to the 3 and 3 charts, 3 minutes. Here we go. Chart number 1 is the S&P breadth. I didn't mention breadth because for a while it has just been overwhelmingly positive. When you look at the cumulative advanced decline lines for common stocks, only for the S&P 500, for the mid-cap index, it's all strong up and to the right. Where it has not been confirmed still is the small cap advanced decline, which has yet to break above its March high. So in general, a market making new highs confirmed by the AD lines all doing it. That's a thumbs up. This is a partial thumbs up because 3 of the 4 have confirmed the all-time, the new highs. Small caps have not. It'd be very interesting to see, given the sectors that are outperforming today, if that happens after the close today. Chart number 2 is the S&P 500, just to focus on this bearish divergence that we've seen. And before you think that this is a 100% accurate, obviously all you need to do is sell right now because clearly the market's going to go lower. I would caution you that the last time you had this sort of bearish divergence was in January, right? Where you had a higher high in price, overbought the first time and not the second time. That creates that bearish divergence. After that, you had 2 pullbacks within the next 6 weeks, both of which were around 5 to 6%. So not the end of the world, but certainly led a lot of investors to rethink what was happening before we resolved to new highs. It's worth noting that after the first one, we never undercut that low. The next pullback didn't undercut that previous low. And so again, higher highs, higher lows, that's a pretty decent uptrend. When that pattern breaks, we need to be concerned. So the bearish divergence is the first warning sign. I think 4120 is the level to watch there. Finally, we didn't get into too much into semiconductors, but I think it's worth noting that the relative performance of the SMH versus the S&PY is threatening a new low. It's actually threatening to undercut the low from last month. While semiconductors can underperform while the market's doing well, certainly could happen. In general, this is a group that tends to do well, sort of a bellwether group. It does well when the market's doing well. When relative performance is weak on the semiconductor group, I don't tend to feel great about the overall market environment, because that tends to speak to overall strength in tech, which has been a decent group to follow. So let's watch that chart, see if the 200-day moving average is able to hold. That's it for today. Thanks so much for joining us every weekday for the final bar. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.